like to start with our opening panel, the investment leaders. So maybe we can just start with a quick introduction from each of our panelists, and then we can get started.
Edward Bonner. I'm an investment advisor at Sprott Wealth Management. I'm based in New York, and we have about 40 billion in assets under management and 3 billion under active management.
Chris Berry, based in Washington, D.C., founder and president of House Mountain Partners. Spent about the last 15 years focused on supply chain issues, trying to answer that existential question of what happens when commodities and technology and geopolitics all collide.
Erez Ichilov, based here in New York, consulting mining companies, recycling companies, and mining tech companies, basically focused on critical minerals. I do it through my own advisory, Cedrus Arbor, which is based right here in New York. Formerly, and I suppose some of you know me from previous rounds, I was the managing director of the investment group at Traxxas while it was part of Carlyle. And before that, I was the deputy CEO of a big industrial company that was focused on nickel mining and producing ferronickel. Originally a lawyer with an MBA, but don't hold it against me. A miner now.
Ellis Martin. I host the Ellis Martin Report, which is a radio program that's aired in Florida, South Florida, for about 25 years. We're also sourced through Apple Stocks, through Thomson Reuters, through Bloomberg, Yahoo Finance. We have a combined audience of about 7.5 million people. Altogether, we provide a source for mining companies to reach investors around the world. I'm originally from New York, but I reside in Malibu, California.
Rachel Ziemba. I'm based here in New York, run as economic and geopolitical risk research firm, working both with mining companies, but also energy companies. So in the mining space, more minerals, which is a definition that's broadening. And really trying to help people sort of navigate the sort of macro geopolitical sort of elements, but I also sort of work on some of these issues from the policy side with the Center for New American Security in Washington, D.C.
I want to just kind of bring it as a broad discussion. So looking at Trump's tariffs, the counter tariffs, trade war threats, everything that's going on. So how is today's geopolitical environment impacting the industry? What are some of the major impacts you're seeing right now?
Tariffs have been a major shock to supply chains. And I think, as everyone knows, once you restrict the flow of critical materials, that's just not good for the global economy. I think that'll come back to bite us, and I think commodities really stand to gain. As soon as you restrict the supply, then obviously the price should react to that. So I think it's actually very positive. All these geopolitical risks are very positive for metals. For industrial metals, it might be a little mixed, but there's been years of underinvestment in those, and so I think there's deeper trends that are benefiting those critical materials.
Yeah, I think there are three headwinds right now facing the battery metal supply chain. Number one is the fact that real interest rates are higher today than they were, say, 1 or 2 or 3 years ago, which of course feeds directly into the cost of capital for any project that you're trying to finance, whether or not it's here in the United States or globally. So cost of capital is going up, which means it's going to get more expensive to build these critical materials projects. Number two, as you had mentioned, metals prices, be they industrial metals or the battery metals, are all over the place, right? Lithium is, dead and buried, depending upon who you speak with. I actually think it'll come back eventually, but lithium's been under a lot of pressure. Cobalt's way up, but that's because the DRC is holding back supply in the market. Nickel hasn't really moved because I think Indonesia is always threatening to add supply. And so every metal has its own supply and demand dynamic, which hasn't really changed from cycle to cycle. But nevertheless, very difficult, I think, if you're an investor to decide, okay, which horse am I going to bet on? Is it lithium? Is it nickel? Is it copper? When the pricing dynamics are so difficult to discern. And then, of course, finally, again, as you had mentioned, the tariff overhang is just it just has investment frozen. I mean, Erez, you and I were in DC last week at another conference, and I feel like there's a great deal of capital sitting there on the sidelines. I know that's, a lot of people hate that phrase, but nevertheless, it's there. And if there is any shred of visibility or certainty beyond next Tuesday, so tell us what the tariffs or export controls are going to look like in 1 year or 3 years from now, you would see a flood of capital come into the supply chain here in the United States, I would argue. So those are the three headwinds right now. There are some things in DC, I think, that are positive, fast tracking permitting. A lot of Trump's executive orders, I think, could lead to some positive outcome in terms of focusing on critical metals. But we can get into some of the politics in a minute. But those are just sort of, I think, the way to sort of think about the supply chain today.
I agree with everything you said, and the risks and the issues caused by uncertainty obviously have affected. But looking at the positive, what has become pretty clear is that critical minerals and for that mining, metal, recycling, and all the technologies that are around that have become front and center. You're listening now to pretty much every podcast that has to do with investing, with macroeconomy, with microeconomy. People are talking about rare earths, they're talking about critical minerals. It's become a topic of a discussion. And once it's a topic of a discussion, a topic of interest, it attracts generalists, it attracts potentially speculative investors, and so on. So on the flip side, all this, the increased and intense discussion level of critical minerals, and through that, mining metals, minerals, etc., is very positive, because once people do decide to sort of join in and jump in, they'll probably do it big time. So yes, the uncertainty has created some hesitation and some hiatus, but also the discussion has brought it into the front and center. This is, besides AI potentially, Miltech, etc., critical minerals have become a hot topic. And if there are a hot topic and a topic of discussion amongst the investment community on all layers, then I think the next step, once things sort of once we start having a bit more of a clear direction, I think the floodgates will open. That's the positive angle and the half full part of the glass, I would suppose.
I agree with everything that has been said on this panel so far, and I think the most important thing that we can take out of this is the fact that critical minerals itself began years ago as a geopolitical phrase or tool of sorts, mostly because China is our enemy. I don't think that's going to last forever. Right? I don't think China's going to be our enemy in 10 or 20 years. We can't live on a planet like that. But for now, that's why critical minerals does exist. The most critical mineral is copper. Dr. Berry talked about lithium and nickel and cobalt, and he's absolutely right. But really, copper is what drives everything we use electronically. So that's the real crux right now. There's just not enough copper as an entrepreneur. That's what I'm into. Now, as far as tariffs are concerned, they don't work. Maybe they'll work in 10 years. Maybe after all this is said and done, we'll have a place where there's a level playing field. But for an economy right now that's been suffering for the last 5-6 years or so, it just doesn't really make any sense. And we've made Canada our enemy. We've beat up our best friend and roommate and kicked Canada to the curb when we here in North America have all the resources. We don't need anyone else in the world. We just don't. And one more thing, I was speaking with my best friend of over 65 years the other day on the phone. We were talking about a personal issue, and he's here in New York, and he's involved in the construction business. I told him to retire, but he's not retiring. He's 7 years old. He says, I'm having a problem right now. Steel has gone up 25, 50%. I said, where are you getting your steel from? Canada. Oh, who's going to pay for that? Well, the company will. They'll absorb the cost. Everything will just go up. But it's a now thing. I don't think we're going to really survive it. I remember during the Trump first administration, years ago, I was in Hong Kong at a conference, and the ASEAN countries and the Chinese entities there were just really hesitant to do business with us, period. And I don't know what that atmosphere is like, but we're going to find out.
Yeah, I mean, to think about different sort of things. So I think just to sort of sum up, I would say urgency of investment, higher interest. I think what I also was down in DC earlier, sort of last week, and one of the things I continue to take away is this challenge of, particularly for some of the more lightly traded metals, the need to build more financial infrastructure, the need to sort of allow businesses to sort of hedge more, because I think, here we're talking a lot, a lot of us attending are sort of interacting with mining companies, but the piece that has been hardest to crack in thinking about both the geopolitical elements of it, but also the market elements, is the processing and is the developing the supply chains. And that's the piece that I think really isn't solved by tariffs. Right, partly because businesses develop their own supply chains, and so they're not necessarily commoditized, but also that it's hard when one sort of major player or set of players controls 80–90% of the industry. And I think that's what's going on. I think it's striking to me that we're having this conversation when key US and Chinese trade representatives are meeting in London. Critical minerals, rare earths, magnets, they're on the table in maybe a more public way than they were a couple weeks ago. I'm sure it was a subtext at that point. So on the one hand, it points to the urgency. The challenge, though, I think, is that we're dealing with investment cycles that don't necessarily line up with political cycles. And so there's some hard trade-offs ahead on the policy side about giving signals to investors to invest. And that's what I continue to hear from people in the business community is this challenge of a bit the policy whiplash of, it was great to see some of the measures in the Inflation Reduction Act, those are being stripped away, but that call for policy predictability is there. Now that's always something industry is going to say, because you want to know what the terms are and then you figure out how you make money. But I do think this is an environment where the good news is, the urgency, the importance of these supply chains is clear, but the challenge is still, how to get there. And look, all of you in this room are part of, how we get there.
I just wanted to jump in with one more sentence to sort of close the circle on this, is that, again, we're talking about two sides of a coin. So if we're talking about geopolitical tension and the uncertainties that we're talking about, mining and a lot of the use cases of these materials are dual purpose.
Yeah.
Antimony, pierces armory, but it's also a fire retardant. Drones can deliver pizzas and they can deliver bombs. So at the end of the day, we're going to need the materials and the minerals either way. So from that perspective, I think it's positive for all of us.
And on that point, I think the other trend I've really been noting is a bit of a shift, not only in the policy community, but more generally of which minerals people are sort of focused on this element. Now, some of that is this uncertainty about the tax incentives and where the tariffs are going to fall, but this continued interest in anything that is linked to the defense supply chain, which I think all of us on this panel would say, not only is it what goes into metal and armor and the like, but of course, the copper and all of the like. But I do think that interest from the policymakers I speak to of the shift that has materialized, both a focus on onshoring, but this dynamic of really focusing on the defense supply chain and making the case that it's in the defense supply chain helps.
Well, how many of us are involved in the discussion? You probably are, Rachel, in Washington, right?
I try.
I mean, I know that the Secretary of Energy, Chris Wright, I don't know him personally, but he comes from the mining industry. He was on the board of EMX for a long time, and somebody put critical minerals into Trump's head. Somebody just said, you need to really pay attention to this here. But how many of us, or anybody in this room, are we involved? Some of us should be involved in the discussion, in the selling of it, in the deal making. We're just not as far as I know.
So, I mean, you talked about how that discourse has kind of shifted towards defense and making sure that we have the supply of materials needed for defense, whereas several years ago it was all about the energy transition, and we had the IRA really backing that. So, how do how do people pick their commodities of focus?
Well, Well, I guess I begin with the probable outcome. So I mean the commodity is the first order risk that you examine in any type of portfolio. So for me, it's which has the most demand in the near term and the highest conviction. And then on top of that, I build up which companies stand to gain the most from that. At Sprott, in my personal portfolio, I'm heavily focused on precious metals because I think that regardless of which direction we go, I think they stand to gain the most. There's obviously more niche commodities that are either out of favor or in high demand that I think will also be very relevant and a useful addition to a portfolio. But you have to make it based on the probable outcome initially in terms of how you weight your portfolio.
Yeah, I think the narrative has totally shifted. To your point, it used to be all about, President Biden and 50% EV penetration and green growth, and now it's all about national defense and drones. That is the name of the game. I think the challenge is that if you think about, again, to your point, the metals and minerals utilized in national defense, I mean, it's rare earths, it's lithium, it's copper, it's a handful of them, but I think the issue is when you think about national defense, like the Department of Defense and their actual need for rare earths in terms of tonnage, it's quite small relative to the overall market. And so in order to devote $1 or $2 billion to build a rare earth mine and processing or separation facility here in the United States, you can't just rely on national defense demand from the Department of Defense, right? It's going to be commercial demand as well, which means that the financing is going to have to come from both the public and the private sector as well.
And that's where the point that brought up earlier, I think, about allies is also quite important, because you might not only do you need private sector involvement, but we're at a time of greater defense investment across a lot of U.S. allies. We have the Europeans spending more. We have the defense secretary in Asia, I think it was yesterday, talking about 5%. There is a lot, there's other demand, sort of supply chains, but that's where I think calibrating the broader trade and onshoring policy is so important, because we can all look here and say it wouldn't necessarily be efficient if the U.S. Military tries to develop and the German, it wouldn't probably be the Germans, but think about the sort of French. And so, we're already seeing this on a smaller scale. I spent most of May in Europe, and a lot of discussions about who's going to get a piece of the new defense investment sort of pie. And that challenge, a lot of companies are trying to get a piece of the German pie, but that question mark about what others will be spending and who benefits. So I think that's where this challenge is. The other thing, I guess, to come back to in this is sort of what happens more generally is also to say, so Amy, you mentioned it's not about energy transition so much anymore. That being said, when I'm in the Gulf, there's still talk about energy transition. But I think here there is an argument. Here the focus is on additive energy. I think a lot of us could wish that additive energy, AI, data center demand, that a wider set of energy mixes were in the mix. But I think the argument for copper, the argument for building out the grid, the argument for all these interconnections is as strong. It's just that I think maybe the policy frame, the words one's using to emphasize, and look. So I think, but that's where I do think the temporary nature of some of the tariff and transactional negotiations potentially complicates us getting to that sort of end goal. So, the next couple of months will be a calibration moment on that. But I think there'll be a window to provide some more certainty.
I don't think anything's going to stray from the point that copper is something that's bankable. And we really can't land on antimony. It's a word that we have to educate the public with, and the general investor's just not going to go there. Nickel, for all the reasons that the two gentlemen mentioned earlier, lithium absolutely has never been reliable as an investment opportunity for 15 years now. The only thing that makes any sense is copper for reasons that Rachel mentioned, and that's where the sovereign money is going to right now. It's looking for copper concentrate everywhere in the world, not for today, but for 3 years out, for 5 years out, for 10 years out. As an investor, I think that's where you have to go, and I think tariffs are irrelevant when it comes to the copper market.
So how is all of this discourse, how an interest in particular commodities, how is that actually translating into investment into the industry? Or is it?
I'm not sure.
Well, so I mean, I think we hear a lot about investment downstream into processing and technology, but not so much investment in the upstream mining of things. There are policies in place to finance those, but they're really I see a lot of the investment flows and the dollar flows go into more downstream applications. And I think that's the challenge is a lot of investors, aren't typically very, comfortable with investing in mining because they've seen the risks, and investing in something that's more downstream, more, technology driven doesn't have as much of the commodity risk involved. Obviously, I think a lot of the, permitting policies are unlocking some investment into mining projects, but from what I've been, hearing on the ground, it's a lot going into the more downstream applications, which is a challenge. Sure.
I think the major question now is no one argues with the issue or the challenge or the need, I guess, for a domestic or a reshored supply chain for critical materials or what have you. The question is who pays, right? When you have a situation where, just take lithium as an example, it's around $8,500 per ton today. That's before tariffs and everything. That's just your China price right now. So that's the floor, and that's where we are. That puts about 40% of the lithium cost curve globally underwater. And so we know, or we don't know, we assume, I expect, lithium demand to double between now and 2030 in 5 very short years. We all know in the mining business, 5 years is a blink of an eye, right? So where is all of the capital going to come from to help this commodity, double in 5 years in terms of demand, if it doesn't make economic sense to fund the mines? And to Ellis's point, copper is about the only one that I think is profoundly economic at this point in time. And I'm not sure if you're even seeing enough capital flow in there as well. So, I think your question was, how is all of this translating into investment? I'm not sure it is, because there's still this disconnect. And I think the Inflation Reduction Act and the Infrastructure and Jobs Act was designed to maybe provide a floor or a certain level of certainty around investment into not just the United States, but our allies as well. And with the big, beautiful bill and what that does to the IRA potentially, or at least what the House has trying to do, it puts it in jeopardy. There are certain aspects of the IRA that are absolutely essential, like Section 45X, to build the downstream portion of the supply chain. And Ed, to your point, the IRA and this legislation in the United States, I think, was very beneficial to the mid and downstream pieces of a battery supply chain, but sort of ignored mining. Sort of said, well, we'll rely on Chile and Australia and Canada and our allies for the raw material. But of course, all of our allies have their own strategies around this as well. So, without more focus on the upstream in terms of, again, providing a floor, thinking through stockpilings, or again, to your point, the permitting, it's going to be awfully tough, to hit some of these supply demand numbers by 2030. But that's the opportunity, right? That's why we're all here.
Yeah, just to add to that, I think still focusing on the midstream is an upstream enabler, which is important. So if some of these projects will move forward, for example, we can talk about it later, but the projects in Oklahoma and so on. If someone has a winery in your district, then it does make sense to grow some grapes. We just need to figure out, and as we've learned over the cycles, if you look at kind of upstream, midstream, downstream, the midstream is hard. That's where, you work hard, you have small margins, you work on TCRCs, on furnace premiums and so on, but miners can sometimes, make a lot of money on the upswing, and downstream is already a different thing altogether. That's already very consumer-oriented, fashion-oriented, etc., on the non-military aspects, at least. But if we keep focusing on that, and if we cannot unclog some of these issues, empowering Exim, for example, to have a greater tolerance than 2% for default, so that they can keep lending. The DFC is going to get funded. It looks like we're going to have some sort of a strategic stockpile, which could act as a, sort of as a buyer of first resort or last resort. And I think we heard a few times in recent conferences that some of the government lending or government support lending is starting to understand that maybe if you solve for what will enable the commercial lenders to step in, some sort of guarantee, some sort of price hedging in a way, then you don't necessarily need to be the lender, and then overall you can figure out how to stimulate the leverage part of and the gearing of capex through the private sector a little bit better. Another thing that I think we might be seeing, although in this country we don't really have that many official PPP projects, like real public-private partnerships, which start with a proper tender or an RFP and they're structured. We do have sort of a de facto type of PPP, because what happens is when you file your applications for grants, for loans, for any type of support from any of these agencies and sort of support routes, one of the things you need to show whoever is looking at your file and kind of ticking the boxes is that you have support from the private sector, that you have a potential off-taker that gave you an LOI or a term sheet, that you have feed in case you're a midstream conversion that someone is going to feed. So the government agencies, let's call it, when they look at a file, they're very much looking at how the private sector is accepting this initiative. And then from the flip side, we know that a lot of the private equities, a lot of the angels, a lot of the VCs, all of us that are investing in this sector, for us, something that gives a lot of comfort and allows us to sort of know that someone has already done a due diligence, that there was a sanity check on the project, was whether they were approved or screened already by one of the, let's call it governmental plans, whether it's for a grant or for a loan or for a guarantee. So what happens is that the PP is that each part of this partnership de facto is looking at the other for comfort and for sort of a confirmation. So even if it's not defined initially as a private-public partnership, in essence, it leads to that, which is something that I find interesting. And again, trying to be optimistic here, this is something that can support the effort and should hopefully enable us to sit here in 2030 or 2032 discussing projects that already went into production, some of them more successfully, some of them less successfully, excuse me, but not be in the same position as we are now, pretty much having the discussions that we had in 2018 when we were talking about the emergence of critical minerals and battery materials. Now that within a few years everyone is going to drive an EV and so on and so forth, and whatever 80% of the grid will be wind and solar. So there is that angle, and hopefully this will be something that can generate some traction and push things forward.
Hopefully can just get both of the P's to do their due diligence more quickly. Still do the due diligence, but speed up that sort of process, because I do think to that point of some of the sort of process of, and it makes sense. You need to, if you don't have an offtake agreement, then you won't have the financing and you won't have the dynamics. But I think given the long horizon of some of these projects, thinking about that, and that's where I think this sort of question mark, especially for some of the minerals that we're still developing the markets for, and creating new hedging tools and financialization doesn't solve all the problems, but at least it can provide some space, especially for governments, maybe not the US right now, but for governments who would want to create a floor, financialization, it's something that we sort of, I think again, is worked on better at a cross-country level. to develop markets. We all know that, when a government creates a market, it doesn't necessarily, or, create a market, it doesn't necessarily go there if it's not there. But I do think that sort of process. The other thing I'm noting, in this context, for some of the critical minerals, yes, you have new money going in, old mines being frozen. But yeah, back to I think Chris's point about precious metals, that is still somewhere we're seeing, sort of money going in. The question is some of it in what segments, but I'm watching particularly this question mark about whether some of the small use cases, some of the technology, can sort of, can scale up, and that's where this cost of capital piece comes in. So. But there are pockets, I think, where there is more capital going in and a lot of interest.
I think that the policymakers lag behind us. We're really the people, and I don't necessarily mean us, although I kind of do. I mean everybody really basically in this building and beyond. Yeah. We organically grow the sector. The money's smarter than everyone, by the way. The money knows where to go and where to invest. So we just have to continue to do the deals. We have to travel like we're doing, coming from all over the world, show up here and just keep the deal flow, keep the discussion going. And then the policymakers, we meet them every now and then. We just say, we're working on this now. Do you want to be involved? It's really a one-to-one, much like this conference is called. It's a one-to-one situation. It's a people business, and that's how deals are being done, because the policymakers just don't know. They're like academics. They teach, but they don't necessarily participate in the process. We do, and it's incumbent upon us to forward that process. And through our years in the business, all of us, we come across deals every now and then, and we put people together. I'm involved in something right now. I can't go into a lot of detail, which a large offtake copper porphyry project in Mexico is going to be that in about 3 years, as I mentioned, Rose is going to be shipped off to the Middle East, because they're building that infrastructure right now, and they will invest in the rest of the world as long as we play ball. And we can, because they're nice people. Actually, all of us basically in this business, we're nice people, and for some reason we're stuck in it. We can't get out of it, and we want to help. We want to help build the industrial evolution of the planet. And I'm not saying that in any kind of crazy Malibu way. I'm saying, AI, for instance, everything's just going to keep eating up the grid, and the grid is probably 30 years behind where it needs to be right now.
Okay, so you're talking about kind of all of the various players. So there's been a lot of talk about trying to bring in more generalist investors just to kind of garner more interest in the industry. Do you see that happening?
Yeah, I mean, I think the discussion around critical materials, is definitely picking up steam from a retail interest point of view, and I think it's about educating those investors because most of them have been used to investing in a completely different segment of the market for over a decade. So it's really just bringing it up to speed and realizing that critical materials and really industrial materials as a whole are kind of the fundamental building blocks. And without that, you can't build the verticals in technology and so forth beyond that. So I think it is slowly happening, and especially if you start to see other segments of the market that are not starting to perform maybe as well, and you start to realize that the flow of materials is restricted and the implications behind that, then yeah, I think more investors will start to pay attention, and that's definitely what we're seeing from our public funds perspective. We're having a lot more discussions with generalist investors. The conferences that we attend, we see new players that are not insiders, because I think for a long time you go to a conference and much like this one, most of the time it's just industry insiders who've been in it for a long time, who understand it, and it's really just starting with the education, and I think they're starting to catch on to that.
Yeah, I haven't seen personally as much interest on the retail side. I think a lot of that is driven by the headlines. So rare earths are very hot right now for obvious reasons we've chatted about. But one of the reasons why I'm encouraged longer term in this sort of idea of green growth or building out a battery supply chain is what I've noticed in the last couple of years is you're starting to see larger pools of capital come into the space. And I'm not necessarily referring to battery players that are doing prepayments or offtakes, but there's a fair amount of private equity capital that is focused on infrastructure in particular, that has said, okay, we can read the tea leaves, we can see how this shift is happening, this shift towards electrification, whether or not it's focused here in the US or China or Europe. But nevertheless, those types of players are at the table right now. And I'm very encouraged, because I've always argued that in order to actually generate or find the capital and then deploy it over a given investment time frame, you need that, what I call money with a long fuse, or patient capital. And that almost exclusively, in my view, comes from the private equity side, who, they do run a pretty hard bargain occasionally. Not occasionally, that's what they do. But they're around for 5 or 6 or 7 years, which is what you need to be able to get the infrastructure in place. So, I'm actually pretty encouraged, again, despite the doldrums around prices are down and interest rates are up and there's policy uncertainty. Again, as I mentioned earlier, I think there's a fair amount of capital that is sniffing around right now and trying to figure out where along the supply chain they want to play. And it's just a matter of time, I would argue, before they come in.
In terms of, generalists, so one thing that we are seeing a little bit, and that's feedback we're getting from some of the mining tech companies, those that are looking at exploration with AI tools to analyze the data and generate the targets and so on, and some of the other more processing-oriented companies, companies that are developing ways to basically take technologies and processes that I think were initially practiced in oil and gas, tweak them, reservoir stimulation, those type of things, and move them into mining, both on tailings processing and on primary, which I think is important. But some of these companies have done kind of seed A, B rounds depending on their stage recently, and what we're hearing is that some of the Bay Area VCs that invest in tech and whatever is the next relevant tech, where they build a little cluster. So if it's quantum computing and that's a narrative, they will invest in 10 companies. They're totally okay with the boom bust of seven of them going bust, 2 of them doing okay, and 1 of them justifying the whole investment. So it looks like some of that capital, which hasn't gone in when we were talking just about the ideology of EVs, electrification, green, and so on, and not even as FOMO when companies like Cobalt raised a lot of money. Part of this seems to be trickling into initially through these more mining tech or processing tech oriented investments, but it can then, I think, proliferate and add, because if you think about it, early stage exploration in terms of the risk profile is very much a VC investment. Again, you bet on 10 potential copper plays, and then 1 of them turns out to be Kamoa-Kakula, and most of them do not. So that's potentially a pool that our whole ecosystem that might be sort of drawn into our system, which I think is good. And in terms of the real sort of generalists, now that everyone is talking about rare earths and critical minerals, and also data centers, AI, digital, the need for much more power generation and a lot more supporting infrastructure. We need to distribute the power somehow. If we keep things simple and don't overcomplicate it, not scare them with the name of the minerals perhaps, or how exactly we're going to process them, but talk about both the utility and the purpose. So utility could be, what are you actually doing? We are providing materials for the drive and for the backup systems in the data centers that enable the AI revolution and the proliferation of digital infrastructure in the United States. How are you doing that? That's already under the hood, in essence. You don't necessarily need to dive that deep. You don't necessarily need to define yourself as an investor in lithium or in copper or in rare earths. You're investing in whatever facilitates for this huge growth sector. So that's sort of the utility of it. And for those where it's also relevant, you can add purpose. I'm not laying bricks, I'm building a school. So you're also through that providing, modernization. Yes, it's still okay, I suppose, to say reducing the amount of GHGs, solving for warming, less carbon, less energy. But you can also say instead of less emissions, less wasted heat and power. So there are ways of I think going through the utility and the purpose that are attractive for the generalists of the various tiers. You just need to simplify it for them and onboard them on the utility and the purpose, and I think then it will be okay. Then they will sort of hop on because it's becoming the theme, it's becoming the narrative. And maybe one of the mistakes we did in hindsight when we were having these discussions kind of pre-COVID and when we were talking about battery materials and about reducing emissions and in terms of purpose, solving for climate change and so on, is that we kept it too philosophical, too ideological, and maybe overcomplicated it for many things, for many people. Maybe we should now sort of learn from that mistake and just say, okay, these are it's not even trends, these are the tectonic shifts on what humanity is going to look like in 2050, what a city is going to look like, what a factory is going to look like, what a workplace will look like, what a hospital will work like. That's what we're solving for. That's where we're headed.
We're always going to be the buddy to infrastructure issues, to AI, to everything else. We're not going to be the story. We're going to be the really cool side piece. So right now, the generalists are only focused on gold and biotech and AI. They're not, we hear about critical minerals, but the money's not there yet. But funds are going to gold, which has zero to do with what we're talking about today, although any of us can speak about it on this panel. And I think that's really our story right now is the tech money coming out of the Bay Area is very, very aware of mining issues right now. They're extremely aware and they've got money to back it up. They've got youth and they've got the power to make it happen. We have to be their friends. Otherwise, we really can't sell the sector. And I don't think generalists are just going to pour into it. I don't think it's going to happen.
And there might be challenges if they did just pour in just in that kind of context, because we can think about other industries and dynamics, and maybe I'm bringing to bear my emerging market, sort of background. But, the challenge, you don't want just hot money that goes in and then goes back out, right? You want that money that's there to stay. I was thinking as Erez was talking about that sort of frame of thinking about the vision of what it's going to be and stripping it down sounded a lot to me like some of the presentations you think about, like, Masdar and some of the things out of, out of the Gulf, out of different things like that. Some of the themes to connect, I think a lot of the whole semiconductor supply chains and others involved have really framed it as, framing with, sort of AI and the AI demand story. Maybe there's some space there. I think one of the challenges for generalists, or for attracting generalist investors, has been this issue of, do you go for the larger existing mining companies who are exposed throughout maybe the supply and have mines that are doing well and others that may not be, or which part of the capital structure is benefiting? And then there's a different challenge with the smaller ones. But yeah, I think thinking about what's the realistic kind of medium-term outlook. Private equity, yes. Sovereign wealth funds to some extent, yes, and SOEs. Also, there's a lot of, I think, different stories out there about private credit, which is the counterpart, sort of in the space. When I talk to credit-focused people in the rating agencies, they're very concerned about the returns there and how things are restructured. But I do think we're talking projects that need medium to long-term capital. And so I think that's where building the bridge and having better hedging instruments, and also capitalizing and thinking about, also how to, some of this will happen organically, but, how to, in a sense, commoditize some of the segments that haven't yet been. And I'm thinking about even on the recycling side, how that sort of comes to bear. Which I think, obviously, there's a whole different story and set of policy mix. And on gold, I think the challenge there has been that, from my perspective, gold is much more, a response to the reset, the shift in currency asset allocation, and also the inflationary dynamics. And so I think it's harder to make that case for commodities that have a real fundamental demand, because we're in a moment now where there's some minerals for which there's a strong fundamental story, and there's others that hopefully that there will be in the medium term. And so I think there's that element. So it's thinking about what's the messaging. Yes, keep it simple, but generalists that come in and come out short term, I might not want that swing. It's about how to send the message about what the returns could look like.
All right, so just to kind of wrap it up, I thought we could just go through the panelists and just kind of maybe you can talk about what do you think are the key themes that are going to define the next year, or what would you send people on to their meetings with a focus on?
Yeah, I mean, I would focus on the fundamental supply and demand of each commodity that the mining company that you're meeting with is actually going after. Understand that first before you decide to spend time diving into the project. Obviously, I think copper has very strong supply-demand fundamentals, and you could say the same for a lot of industrial commodities as well. I do think in the more niche commodity space with smaller markets, they're more those are more prone to wild swings, and so you could also be investing based on the current hype and not necessarily long-term private equity investment, but just more generalist attention, and think, oh, well, everyone else has eyeballs on that. Well, typically, I feel like if that's the case, then you might be a little late to the party especially in terms of kind of smaller niche commodities. And given the set of geopolitical concerns right now, everything is very elevated. Maybe it'll get worse, but the risk also is that things could get better, and that would liberate supply. So I would take that into consideration before you go into those meetings.
Yeah, I think it's obviously a difficult question to answer. I mean, we're all watching a movie that we've never seen before. It's not a remake. This isn't A Star is Born again or something like that. I mean, this is a movie none of us have ever seen. I hope this story ends better than A Star is Born did, by the way. I expect it to. But my point is, if you're thinking about the next year or two as you go in and talk to these companies, I think it just boils down to fundamental junior mining investing basics. Has the CEO, has the management team done this before? Have they developed a mine? Have they built a mine? What does the balance sheet look like? And this company survived this trough for an indefinite period of time based on cash or access to cash. And then, of course, if it's on the strategic side, what are their links to Washington? What are their links in the EU? And how can they partner with the public sector to try and get to the other side? So not terribly optimistic in the next 12 months, again, because of some of the overhangs we chatted about at the beginning of the panel. But again, longer term, I think that's how I would look at these companies.
Definitely looking at the fundamentals, because you can control what you can control, and it's not everything. The issue with some of these commodities and some of these materials is that there's a very strong demand case in almost any scenario, but they're relatively small. So the ability of the supply side to quickly respond and sometimes even manipulatively respond, if you want to go into geopolitics and conspiracy theories, does create some sort of overhang on relatively small materials like lithium or nickel, where even if lithium grows by 300% and it's 4 million tons instead of 1 point something, even nickel, that's been around forever is still, we're talking in the single digits. So these are some of the issues, but yeah, look at the fundamentals of the company, at the entrepreneurs, at the resource, and what I think could be some sort of a narrative and maybe solve a little bit for what we, the cliche of patient capital. I think that projects that are looking at brownfields, looking at tailings, looking at things that are quicker in terms of time to market. And there's also a lot of technology that's going into that enables now to extract and to process more efficiently. So I think brownfields, tailings, dumps, etc., are a narrative to follow and could sort of be, they're still part of our early stage mining ecosystem, but they may solve a little bit for something, at least in the fourth dimension of time. And similar to that is recycling, and I don't necessarily mean batteries, but everything that has to do with urban mining, with automotive waste, with industrial waste. There's a lot of inefficiency there, although it's been practiced for 100 years. And there are companies now that are basically using processing methodologies and technologies that squeeze more yields out of complicated polymetallic primary resources and moving them into various waste streams. And this again solves for time to market. It's another angle that adds. It's another, of course, supply source. So one may argue about the effects it has in terms of where the price ends up on when the S and D interact. But that's another thing I would look at as someone who wants to be involved in materials and critical minerals, is these type of streams and companies that have businesses or projects that are related to that.
I think it's really an issue about connecting with the end users. And they're in Asia right now, primarily. And we need to travel, we need to get out there, we need to build these relationships. We're isolated in North America, we just don't know, but all of us have traveled. I know Erez has, Michael has, we all have. And we're there, the atmosphere, let's say in Australia is happy compared to Canada. Canada has sad face right now. And Australia is like, where's the next project? Where's the next deal? And they're proximal to the end users. So we need to close that gap proximity-wise. And we need to build those relationships. Again, it's people. And what we have here is space, and we have resources. And look, I don't believe in forced globalism at all. That's total nonsense. But organic globalism, let's offer incentives here in North America to bring those factories here. Not through tariffs. We don't have the capability to build these factories anymore. We shipped that out 60, 70 years ago. You know, Nixon did that. We shipped everything off to Japan and the ASEAN countries. So we just can't do it in 5 years. We can't do it in 10 years. We can't do it in 20 years, but they can. In a modular fashion, they can bring factories here. They can apprentice our people who don't know how to run them. Meanwhile, we pair with the colleges and the universities, the young people who are involved in tech. It's a win-win. It's not a generalist issue. Generals are not going to pile into this sector, but that money will.
Yeah, I mean, I sort of second or sort of you know what's been said. I think the other thing to watch, depending on the jurisdiction, is, you know, Chris mentioned, you know, links to Washington if necessary, but also one of the other trends that's been that I think will continue in the next few years is a whole number of countries wanting to move up the production curve to sort of add value. We've talked a lot about the midstream being challenging and the like. We've also talked about sort of that specific countries, you know, sort of that question mark about managing supply, but really asking those questions depending on the jurisdiction of, is this going to be somewhere where, you know, where not only is the offtake, you know, sort of available, but are there going to be challenges and things along the way where processing needs to be developed? There can be opportunities there, but I think sort of going in, understanding that, and that goes back to the argument of, is this someone who's, you know, sort of done this before? Because I do think on the one hand, things are changing. It's not the same movie, but that pragmatic sort of response is quite important. And, you know, I think this whole environment also of, you know, are they, you know, connected into, I think more generally, we haven't talked a lot about this because it's junior miners, but this trend of the end users, whether it's OEMs or others, or energy companies moving into the space because they're thinking about those dynamics, watching for how those trends are developing and which companies can, which metals and segments of the market can benefit from there. But, that's where, these are specific conversations, and, look forward to having more of them with you in the breaks.
We have one quick question before we wrap.
Hi, I'm Ahmad Al-Sati. I run a global commodities fund. I guess the basic question for me is, where is the cash, right? Mining companies consume a lot of cash.
Yeah.
They have not returned cash to investors over the last decade. Plus, and even though I agree with all the secular points you guys made, even with gold at an all-time high, junior gold mining companies are just not sending cash back to their investors. The frackers figured it out, right? They now can manage the rig count in order to be cash flow positive and profitable to the investors. What will it take for the miners to figure it out?
Does anyone want to go on the record with
We have
that
no
response?
answer.
Yeah, exactly. And probably the answer is going to be which sectors and which subsectors figure that out, and that may take us back to the fundamental stories. Now, as you highlighted in the gold context, it's booming, but it's much more the financialization that has been benefiting necessarily than the miners. There's not been the kind of dividends. So, as you say, something to watch, which then starts this whole process.
Yeah. Years, I think, figured it out 100 years ago already, right? Keep the diamonds in the stash and distribute them very slowly to control the supply side.
Yeah.
All right, so I want to thank our panelists for joining us and the audience.